$1 trillion a year. That is the United States trade deficit with the rest of the world. Now, what does that have to do with tariffs, though? In this video, we will explain. Now, first, the idea behind trading with different countries is that one country will specialize in something and another country will specialize in something else. By them becoming very efficient at producing a smaller amount of goods and services, they are able to produce a higher output with less resources. And then by trading, everyone becomes better off. Now, maybe that is a little idealistic, but that is essentially why trade in free markets have created so much wealth in the world. Now, with the introduction of tariffs, what that is it adds a little bit of friction to this process. It is effectively disincentivizing certain parties from selling to other countries and other countries to produce domestically. Now, we mentioned the idea behind that is because they want to try to spawn more domestic production, thinking that would improve the economy. But as we touched on in the last video, there are a lot of other negative impacts that can happen from tariffs. And exactly how that all weighs out is not entirely clear. But right now, I want to talk about this $1 trillion trade deficit. Let's say the United States sells goods to China and China sells goods to the United States. Now, in a perfect balanced world, what would happen is that China would buy exactly the same amount of stuff from the United States as the United States bought from China. If this was the case, there would be no trade deficit or surplus. But what is actually happening is that in the United States, since American consumers are the richest in the world, and certainly at the population level we tend to buy a lot of stuff from everywhere. This has meant that we have trade deficits with many different countries, especially because it is very often cheaper to produce stuff in other countries than in the United States. So with China, for example, the United States ends up buying a lot of goods from China, but China doesn't buy the same amount of goods from the United States. And that creates a deficit. So what plugs that deficit, though? This is where it gets interesting. If China is selling goods to the United States gives China dollars, US dollars. So now China has hundreds of billions of US dollars. What can they do with those dollars? Well, they could either buy US denominated assets, which they do to some extent, or they could buy US treasuries, which they also do. China right now has one of the largest US treasury positions, owning over $750 billion. And in fact, internationally, about 1/3 of the US's international debt is owned by foreign countries. Now, that is not necessarily problematic in and of itself, except if it continues to happen at a very high rate, because eventually the US will have to pay back its debt. And when it does, that is effectively a transfer of wealth from the US to these countries abroad. Now, just to rewind for a second, when China sells a lot of goods to the US and has all of these dollars, there is one other thing they can do, which is exchange those dollars for their own currency. However, they don't want to do that because then that will increase the value of their currency. If they use their US dollars to buy Chinese yuan, that's increasing the demand for their currency, which will increase the value of it. If that increases the value of their currency, then it becomes less attractive for people in America to buy Chinese goods. That is why they do not actually want to exchange these US dollars into yuan. Now, if they did do that, though, that would effectively put more US dollars back into the market, weakening the US dollar currency. Now, if you are confused right now, that is totally fine and normal. I think one of the most important things to understand from this video is just how confusing all of this is. There are so many different puts and takes from a currency perspective, monetary policy perspective, trade perspective, and we haven't even hit on how interest rates can be impacted. When foreigners buy US bonds, it increases the demand for them and pushes interest rates back down. Now, you do not, again, need to understand all of this. Really, the purpose is to understand that this is confusing. And anyone who says they understand exactly how all of this is going to impact the economy is not really being truthful with you. Because not only do we have all of the actions with tariffs that the United States is currently taking, we have the possibility that other countries implement their own policies. Now, the really scary scenario is something akin to the 1930s when the United States introduced the Smoot-Hawley tariffs. Many people will say that these tariffs helped cause the Depression, and that is probably not true, but it certainly was a sort of last nail in the coffin. Because what ended up happening after those tariffs were introduced is a lot of other countries introduced their own tariffs. And so if countries are now only really trading with themselves, what that means is that there's going to be a lot of economic inefficiency. Because if the United States has to make all of its own, let's say, semiconductors, that is going to be problematic because we do not have the same sort of capacity that Taiwan has right now to do so. Now, there's a totally valid reason to want to build that up, and they are trying to do so, but that takes many years. In the meantime, what's going to happen is that Taiwan is still really the only place to make leading edge semiconductor chips. And if those are tariffed, then that simply means higher prices. And in the last video, we talked about how these higher prices can flow through the entire economy and affect consumer spending, confidence, unemployment. Now, I do want to make one last point, which is that it's not invalid to worry about this trade deficit. Warren Buffett actually had this article he wrote in Forbes in the early 2000s about the concern of a growing trade deficit. Essentially, what a trade deficit means is that over time, as the United States buys more and more goods from foreign countries and is selling less to them on a relative basis, that gap is plugged by debt. It's plugged by debt because first they get dollars, and then they put those dollars into treasuries or US-based assets. Now, his concern is basically that as a trade deficit continues, and we are giving them all these US dollars for their goods, and they are putting these US dollars into US treasuries, we effectively owe a lot of debt to a lot of people, and future generations will bear the brunt of that. Eventually, we will either have to pay back all of this debt by raising taxes or by printing more money. If you do either of those, though, it is effectively a decrease in the wealth of the United States. Because even if you print more money, as you increase the money supply, you are decreasing the value of your currency. That is all to say that value cannot be legislated into action nor created by a printing press. The United States itself has to produce more goods that are of value to the rest of the world. And now tariffs are kind of a way to artificially stimulate more demand for goods produced in the United States because the United States is going to make it cost more to produce elsewhere. However, as we noted prior, free trade tends to benefit everyone. The best case scenario for the United States would not be tariffs, but would be to figure out how to continue to create more valuable goods and services for the rest of the world relative to what they consume. Now, this is the most optimistic scenario where the United States continues to innovate and create new products and services that relative to their consumption allows them to outgrow this trade deficit. But without that, what is happening is that the United States is really resting its laurels on its reserve currency status and the fact that everyone still wants our US dollars. However, if that ever changes, it could be a big problem. Now, as an investor, what exactly you should take into account from all of this, to be entirely honest, is not clear. Because there's always really catastrophic potential outcomes that can happen when you are investing in a business. A depression is always a possibility. However, if you invest thinking of the worst case outcomes always, it's likely you wouldn't ever want to invest. And so it is on each investor's own judgment to decide what they think is the most likely outcome of a given scenario and whether or not the risk they perceive in making an investment is worth the return. And now you see how quickly this got very complex though. What is not complex though is the idea that a company that creates a lot of value for consumers will generally be able to get a fair value back in return. And that will be regardless of what is happening in the world. Now, there will certainly be ups or downs, but that tends to be the most ever-present variable. There are companies like Coca-Cola that have existed some 100+ years and continue to make a strong profit. That is why we prefer to focus on the competitive advantages of the individual business and invest in businesses that are very high quality and can continue to create value across time and protect that value they are creating. Now, to understand what kind of businesses do that, you should check out this video here on what makes a business great.